Gujarat Gas zooms nearly 8% following a major restructuring scheme which proposes a merger of GSPC, Gujarat State Petronet and GSPC Energy into itself. Gujarat Gas's gas transmission business will also be carved out and be listed as GSPC Transmission.
SJVN, NHPC and RailTel all climb more than 2.5% after the companies received Navratna status on the back of a strong financial performance.
Indian Hume Piper surged over 8% after the company get a letter of intent of a project worth over 859 crore from the Tapi Irrigation Development Corporation.
Dixon Technologies is down close to 4% after the management tells CNBC-TV18 that FY25 growth will be slow as the company is in phase of ramping up its operations.
And Moil has slipped in today's session after the company has cut prices of ferro grades of manganese ore and fines by up to 20%. The stock is down 3% this morning.
Hello and welcome to Chartbusters. I'm Nigel and with me is Hormuz. Well, Hormuz, it's a good start to the week. We're trading in the green, though. The Nifty Bank and the mid-cap index are doing a relative underperformance, but all eyes will we be 13-time lucky? The Nifty bulls are eyeing that record.
Well, 13 is not considered a very auspicious number, but the Nifty is definitely eyeing a 13th day of gains, and it'll be difficult to dig out when was the last time that happened now. But it's been good going for the markets. Then 25,300 on the index. We made a high of close to 25,320, and we are consolidating around those levels now. And as Nigel mentioned, right, 13th time lucky, but the Nifty Bank continues to remain flat. It closed above a very important level of around 51,350 on Friday. It remains around the flat line as we speak, and it needs to cross that 51,500 mark for further upside. And sector specific, of course, the broader markets are not doing too well today. The mid-cap index is down around 0.5%. The small-cap index too trading on the flat line near with a negative bias though. But what's doing well in today's session are FMCG stocks and IT. The FMCG index is holding on, the top gainer today in terms of the sectors, of about 1%, and the IT index holding up as well.
Well, that's been the trend, Hormuz, for the last few days, that the large cap has actually been outperforming the mid caps, and that's similar as the scenario that's playing out today as well. But let's get in Shivangi Sarda of Motilal Oswal Financial Services, who joins us on the show. Hi, Shivangi. Good morning. Good to see you. Ben, hope you're having a good start to the week. Tell us what's the trade on the Nifty. Where do you see us head on the Nifty? And if you had a long position, where does your stop loss come in at?
Very good morning, Nigel and Hormuz. Thank you for having me. So, of course, we've seen September has started on a spectacular note, your favorite month as well. But, of course, bulls have been making a record high, and we are seeing gradual up move in the index from the last few sessions. The good part is that follow-up buying is still visible. And, the entire sectors across board are, witnessing buying distribution evenly. So overall, markets are looking quite positive even here onwards. And we can look at, 25,500 as the next level that we're looking out for Nifty, and then 25,750 marks. The support comes around to, 25,000 levels, which will be an important level to watch out for. But overall, buy on decline starts to continue.
Oopsie.
I guess you have lost the line there with Shivangi. We'll get back, touch base with her soon. But as Shivangi was mentioning, right, the uptrend continues on the index, and there are specific stocks that are doing well in the broader markets. And the three PSUs that I wanted to speak about, we highlighted them in the highlights as well: SJVN, NHPC, and RailTel, all three of them trading with gains of anywhere between 2 to 2.5% in today's session. SJVN, and all three of them, Nigel, are down almost 18 to 20% from their record highs.
Right.
So, and yet it's the kind of run that these guys have seen all through 2023 and through this year as well. That has been a key talking point, and all three of them is seeing a positive reaction to the Navratna status that these guys have received.
And the stocks, actually, the two of the biggest gainers today on the Nifty are the Bajaj twins.
Yep.
Bajaj Finance and Bajaj Finserv. Just take a look at both those two stocks. 2.5 to 3.5% gains is what we're seeing out there. Big up move, and actually those stocks, they started more or less flattish, and they're building onto those gains in the first 90 minutes of trade. So keep an eye out on them. Also, the other couple of stocks that I'm looking at is Whirlpool. Last few sessions have been good for this counter. Today it started off in the red, but Whirlpool has done a turnaround, and that stock currently at the high point of the day. I'll tell you what, by the time we get Shivangi back with us, let's shift focus to our special segment. We get a few ideas for profit from Money Control Pro. Nitin Agarwal of moneycontrol.com joins us to talk about a stock that he's tracking closely. Nitin?
Hello, the company that I have chosen for today is Endurance Tech, which is an auto ancillary company. There are a couple of factors that make us upbeat about the company. First, let me touch upon its Q1 number briefly. On a YY basis, it registered net revenue growth of around 15.9%, driven by the India business and the growth of the tooling and the machine component business in Europe. Its EBITDA margin remained largely stable. Now, there are a couple of factors that make us upbeat about the company. First, the outlook for the two-wheeler segment, which is the primary segment this company caters to, is very positive, encouraging all its customers are witnessing significant growth momentum. This is evident by its order book. In Q1, the company secured an order book of around 184.3 crores from OEMs other than the Bajaj Auto, of which 106 crore is from the EV. Coming to the European market, the company continues to outperform the industry growth and growth of 4.6% in the Q1 basis, driven by the sales of its tooling business and the new orders in the machine component business. The management continues to see improvement in the demand in the European business. Endurance secured an order worth around 3.1 million euros in Q1 FY25. In terms of valuation, the company currently trades around 33.8 times FY26 projected earnings, which we believe is largely reasonable. We advise investors to accumulate this stock on any correction or any weakness.
Some ideas for profit for Money Control Pro, Endurance Tech, the stock in focus. Time for a short break. Up next, we have the management of Lxmi Organic. Rajan Venkatesh, the MD and CEO, and Harshvardhan Goenka, the ED of Strategy and Business Development, will join us to give us the outlook about their FY25 business. Stay tuned, back on the other side. Back with us here on Chartbusters. Now, Protein eGov is looking to bid for the IT department's project for the development and maintenance of PAN 2.0. Now, CNBC-TV18's Yash Jain caught up with the management to get a fix on the company's prospects and began by asking him about the new business verticals that the company could scale up in. Listen into a slice of that conversation.
Our large assets, which are today mature businesses in a manner of speaking, are in the space of taxation, in the space of pension, and very clearly in the space of provisioning digital identity. So as you said, we are meeting customers, or we have, fintechs around us. Today as an organization, on purely the provisioning of digital identity, we power the entire BFSI sector, right? So that is a very clear, big line of business for us, because we are one of the companies which is uniquely positioned. All four facets of digital identity are provided by us, which no other company in the country does, because we provide services as a service agency to UIDAI, which is on the back of Aadhaar, whether it's e-sign, e-KYC or e-authentication. And by virtue of the fact that we issue the PAN card on behalf of the IT department, we also hold the PAN database. So online PAN validation is another service we offer. So when you're completing any digital onboarding journey, you're completing any identity authentication journey, capital markets transaction, transaction in the property space, you're somewhere or the other touching a Protean, asset behind it. So directionally, we are also seeing that while we continue to go strong in contributing to the digital public infrastructure, as you know, we've moved beyond tax, pension and ID and gone into digital commerce with ONDC. We are looking at education and skilling, health, agriculture. We also want to play as a vertical, integration, and now contribute at the app level. So the app layer. And that is where we are looking at contributing in the buyer-seller space with ONDC. We built a complete open commerce stack over there. We are looking at, again, doing a lot of stuff on the data stack, where we use our account aggregator license also. And we are looking at credit scoring, and similarly areas like providing digital onboarding and lending journeys completely as an end-to-end application.
A lot has happened. A lot of investments have been made in terms of the infrastructure that you wanted to build. Traditional businesses are firing well, and now you're looking to add new businesses, which I am assuming will give you a better margin profile. Keeping all of that in mind, and then looking at FY25, what kind of revenue growth should one expect in terms of all these three things coming together? And margin profile, as I said, new businesses also getting added. The blended margins, could they go back to those 15-16% levels? Could we get to see that?
Yeah, so let me break it up on two aspects. See, largely our investment has been in people and tech. We continue to remain an asset-light company. Especially what we are doing in the new age DPIs is largely done on open source technology. So consequently, as a result, there is no heavy infrastructure capex expenditure coming in. So you're right, the existing businesses continue to be strong, they have headroom, but they are a source of stable growth.
Correct.
As we look at new businesses, since we are in a way doing a vertical integration, we do see that there's a better margin profile in these businesses because of the value-added services you are giving, which is not at the foundational layer, but at the app layer. And that is where we see the margin profile to be better out of them. But since these are new businesses, I will break it into two parts. We feel that largely our investments in people and in tech have been done. The new products are there, they are out in the market. But to see the monetization coming through, we definitely see it a journey which will take, in the next couple of years to really start showing impact into the margin profile of the company.
Okay. Still waiting for those two numbers from you. For FY25, the revenue growth could be around what levels, if you could guide the street on that?
I can't make a forward-looking statement, as you're aware.
But could it be in the range of about 20 to 25% going forward? Because FY24 was a strong year over a strong base. Could it be similar to those levels, and could margin profile improve from where you were at FY24?
So as I'm saying, we will definitely see new businesses firing. We've launched quite a large number of new products this year. You would have seen us talking about we've launched a full stack of API marketplace on Protean Rise.
Correct.
We've done CKYC, which is again a great need of the fintech sector, the BFSI sector, rather, the bank's compliance and putting up the KYC data. eSign Pro is something we've launched, a complete documentation suite. So all these are basically our interventions which are coming on top of the infra layer. These products will definitely kick in because most of the launches have been done in the last quarter. So we still have 2 quarters to start seeing returns on these. So definitely we see there'll be improvement in margins with these contributing in. And as I said, on the bottom line in terms of the investments, the people and the tech is there. The new products coming in will definitely improve the profile.
Okay, interesting chat there Yash had with the management of Protean. But for the time being, we slip into a short break that promised chat with the management of Lxmi Organics on the other side. Don't go anywhere. Welcome back. Well, as promised, let's get chatting with the management of Lxmi Organic. But just to alert you, the stock price in the last 1 month or so is up by close to around 15%. However, in the last 1 year or so, it's virtually unmoved. Now, the company has presented an expansion plan worth around 1,100 crore rupees, which will be completed by 2028. They've also guided that they'll double their revenues, triple their EBITDA. So that's going to be quite interesting. Let's understand more. We have Mr. Rajan Venkatesh, the MD and CEO, and Mr. Harshvardhan Goenka, the ED of Strategy and Business Development at the company. Good morning, gentlemen. Good to see you all in. Well, we've looked at your ambitious plans, but the start to the year actually has been quite subdued. So in the near term, that's for FY25, what kind of a growth number should we work with? And what are the margins? Last few years, I can see the revenue number has been more or less flattish, and margins have been in that vicinity of close to 9 to around 11%. So give us a near-term guidance. We understand the 2028 vision, which we'll get into.
Right. So namaskaram. It's a pleasure that I've been able to join this first time for me. And thanks for having Lxmi in this platform. So let's just take a step back, right? When you spoke about our previous year performance, the one thing we have done exceedingly well is while the building blocks, that is acetic acid and others, which skyrocketed during the COVID period, actually have moderated down. And that's where you see our revenues being flattish, but this is actually backed up by volume growth. In the last financial year, we delivered 20% year-on-year volume growth from our business verticals, primarily essentials. And this was done on the back of continued operational excellence. And that is what we will also charter the journey into this full year, because the efforts we started last year will pay out on this full year basis. In quarter one specifically, we had also had the scheduled turnaround in our essentials business, and that's a large volume business. That's why you saw quarter on quarter, our volumes were down by 7% on essentials. And that is also something we have called out. But our specialty business with the product portfolio differentiation continues to drive profitable growth for us. So as we are also chugging towards this financial year, our ambition remains that we will deliver profitable growth and profitable volume growth, both on the volume level and also at the EBITDA level. That remains our focus. But I think you can respect that giving numbers specifically is something we are steering clear of at this point in time.
Okay, we take that note. Essential segment, there was a shutdown, so that's why volumes impacted. So
Absolutely.
Since you're focusing more on volumes than on revenues, tell us what is the volume growth for the year that we should work with in both the segments. Give us at least a band.
So again, just to keep it in perspective, it's not only volume, it's always in the essentials part, it's a lean and reliable business. So you trigger by two elements. One is volumes. That's why you look at asset bases and sweating those asset bases. And then you look at specific margins. So we steer by both levers, neither either one or the other. Right? And that's why last year we delivered 20% year-on-year volume growth for essentials. And the ambition remains again to deliver not the 20%, but a strong volume growth also year-on-year in FY25. That remains the focus.
So would 20 become 25 this year?
No, I think if you have done the entire operational excellence journey, you can only squeeze out so much. I wish we can, but no, certainly that's not the thing because you can only have efficient plants one time around. But incremental capex and incremental is what we will certainly continue to deliver.
Interesting. Now, I wanted to ask you about your export markets as well, and I'd like Harshvardhan to come in on this one. How is the demand panning out over there on ground within the export markets for the first quarter? It was almost 2/3 of your revenue. Now, how does this mix shape up going into the rest of the FY25 as well? Does it remain as it is, or will there be a change, or you see more of domestic demand coming in for the rest of the 3 quarters?
Sure. Well, thanks for having us, Nigel and Hormuz. So on the export markets and Indian markets, I think Lxmi has been both 70-30 sort of mix, with the majority share being domestic. But given the entire headwinds in the entire European landscape, we've had to move volumes to other markets, and a lot of that has come in actually in India. So we've managed to move volumes in India, and I'm primarily referring to our essential segment right now, which we will see continue over here. Europe will continue to face headwinds as far as our own outlook is concerned. On the specialties, it's more of a balanced view. We are evenly split between our international and domestic markets, and we see that mix to broadly continue for the rest of the year.
All right, let's focus on a couple of other aspects. Fluorochemicals, that's a very small segment. FY26, what is the revenue number we expect from this segment?
So first and foremost, the focus in FY24 was to get mechanical completion of all our assets. This was a project that was delayed from our lens. So that was the primary focus. So we will see revenues from that asset already coming into play in this financial year, second half of this financial year. And I think we have already laid it out there in a 3-year period is when we focus on the peak revenues from that asset base.
Okay. Well, could you give us a number?
No, I would like to be a bit shy of giving numbers, but we will certainly make this very transparent. We have given the peak revenues. We have said peak revenues from that asset base is 200 crores. That will be achieved by the FY27 period, and we will start ramping up in this financial year second half. Hope that helps.
Okay, got it. All right. So you're talking about doubling your revenue. So my guess is that by 2028, your revenues will be in that vicinity of around 5,600 crores, right?
Yes.
And what would the margins look like, give and take everything at that point of time? What is the targeted margins? In the past, you've done 12-13% as well. So I ask you.
Yeah.
Right. So maybe Harsh, you want to take that? Yeah.
Yeah. No, I think our ambition as we laid out was about 1,100 crores of capex, split evenly between the essentials and specialties. We'd also become very clear with what do both of these businesses and how do we drive them financially. For every dollar invested in the essentials, we will expect an asset turn 3 to 5 and an EBITDA margin between 8 and 12. The specialty part, given it's more capital intensive, will give us an asset turn between 1 and 2, but EBITDA margins would be higher, and given the specialty focus, will be between 20 to 25. So that is how we will split both businesses, which will then eventually lead to the 2.7 to 3 times of EBITDA overall. And the balance, however, given the capexes are evenly split, will broadly remain the same in terms of revenue.
So margins go up to around 13 to 14% since it's going to be more on the value accretive side?
Correct.
Yes.
That's the range in which we will be.
13-14% is what we work with, right?
Yes.
Right. And since you spoke of capex, I want to ask you, what does that do to the debt picture on your books currently? What is the current debt that you guys have? And once you execute your capex plans, what does that do to your debt? And is there a timeline by which you will reach peak debt and then start tapering down from there?
So debt on our books is very, very limited. You've seen our financial statements. We have raised a QIP in the course of last financial year of 259 crores. Cash flow from operations remained very robust. We had a very strong cash flow from operations in the last financial year. So I think these are the levers which will keep us in good stead. Our board is very adamant that we should not over leverage. And so we can go up to 0.4, but I think we will do this only very prudently.
So you'll remain debt free by the end of this capex?
That remains a core focus.
And final question, ROCE, it is only at around 10%. You all see it moving up by 2028?
Yeah, our ambition is that in the past, as our capexes play out, we've actually delivered a 20% ROCE. And given our product mix and improved profitability, we expect to come back to that level.
All right, gentlemen, thanks a lot for joining in. I'll tell you what, the street has been waiting for some kind of delivery. Last few years have had its share of challenges. For 2028, you all are giving very ambitious numbers, and we're going to hold you all to these numbers. Doubling of revenues, margin moving through 13 to 14%, and ROCE at 20%. Let's see how you'll go about it. Thanks a lot for joining in here on Chartbusters. Well, on that note, though, we'll wrap up on this show. Trading Hour comes up next.